Let's have a look at a quick introduction to value-added tax, or VAT. VAT is divided into two categories, namely output tax and input tax. Output tax is defined as the tax charged by the business on the sale of goods or services rendered by the business. Input tax is defined as a tax payable by the business for goods purchased or services delivered to the business, including imports. The output tax and input tax are then used to determine the amount of VAT that is either payable by the business or that needs to be refunded to the business from the revenue services. So, this would be output tax less your input tax would then be equal to the amount payable by the business or the amount that needs to be refunded to the business from the revenue services. The Value-Added Tax Act 89 of 1991 provides for two types of supply. Taxable supplies at 14% or zero-rated supplies, on which VAT cannot be claimed or charged. Now, these exempt supplies include zero-rated supplies, which include items like brown bread, petrol and oil, transport on international flights, and agricultural goods. This means that a vendor making exempted supplies cannot claim back the input tax. Then exempted supplies include things like financial services, educational services, trade union contributions, and road or rail transport. VAT is accounted for using two different methods, either on the invoice basis or the payment basis. Under the invoice basis, tax is accounted for when an invoice is issued or when receipt of payment has been issued, whichever comes first. And under the payment basis, tax is accounted for when payments are made, purchases, and when payments are received, sales.